Hey, what's up, my friend? So in today's training, I want to share with you the 5 things you must look out for before you place a pullback trade. And it doesn't matter whether you're trading stocks, forex, commodity, futures, the concepts that you're about to learn can be applied the same. So let's get started. Number 1, trend, right? Here's the thing, when you trade pullback, you must have an existing trend. You can't trade a pullback in a range market. It doesn't even make sense, okay? So is there a trend? That's the first question you want to ask yourself. And one tip that I have for you is that when you look for trends, right? You want those trends with visible pullback, with clear retracement, because this makes it much easier for you to time your entry. So one tip for you is to look for trends, right, that pull back towards the 50 MA or deeper or more. Okay, so let me just share with you a few examples. So these are type of trends, right, that I like to trade off. We can see that, we have a down move lower, we can see the pullback, another down move, another pullback, a down move, and maybe another potential pullback over here. So you can see that this downtrend, the trending move, the retracement move, it's all very nice and clear. Another example, this is a stock example. Again, trending market trends up higher, pulls back, trends up higher, pulls back, trends up higher, pull back, up, and maybe possible another pullback over here to retest this swing low. So you can see that this is the type of trend that I want you to focus on, where the ebb and flow, right, is obvious. And if you pull out the 50 MA, you'll see that it will tend to retrace or pull back towards the 50 MA or more. So this is just a rough general guideline. And let me share with you trends, right, that I avoid. Is trends like this. You can see that this trend is quite different over here. If you look at the recent swing up, right, you notice that this trend is just pretty much grinding up higher all the way, and the pullback is very shallow, right? So it's difficult to time your entry on a pullback, right, if your market is trending in such market condition. And these are type of trends that I would avoid. So again, focus on trends with a clear visible pullback, retracement. These are the ones that are much easier to trade, and the 50 MA is just a very useful tool that you can use to decide whether the trend is worth trading or not. So that's the first thing, trend. Number 2, the area of value. What is the area of value? This simply means, right, where might potential buying or selling pressure come in. This could be things like support and resistance. Like support, right, is an area where potential buying pressure could come in. Resistance is an area where potential selling pressure could come in. This is only one area of value. Could be trend line, could be moving average, etc. This is what I call area of value. So let me just share with you an example. So if you look at this one, okay, this is Euro against the Aussie. We have this upward trend line that serves as the area of value that you can see over here. This is an area of value for this market and on this time frame, the daily time frame. Another one, if you look at this stock, right, Zoom, you can see that this one serves as an area of value using the 50 MA. Tested it once, almost twice, thrice, 4 times, and possibly maybe a 5th time over here. So the 50 MA here serves as an area of value. Or if you look at dollar Canadian, okay, over here, I think I didn't have any lines here, but I can just draw some simple basic support resistance that could serve as an area of value. Okay, so you can see over here. Okay, let me just change this to black. Usually my levels are black. So you can see over here, right? These are potential area of value on the chart. So simple stuff, right? So basically ask yourself, where might potential buying and selling pressure come in? So this is the second question to ask yourself, right? To identify the area of value. Moving on, the third thing, entry trigger. And oh, by the way, if you are enjoying this training so far, smash the thumbs up button. If you don't, then hit the subscribe button. So moving on, the entry trigger. Once you have the trend, once you have the area of value, the question is, what will get you into a trade? When do I enter the trade? Okay, so this is where you can use candlestick patterns, right, to help you time your entry. This could be things like reversal candlestick patterns like a hammer, shooting star, engulfing pattern, or price rejection and stuff like that. So let me share with you some simple basic candlestick patterns, right, to get familiar with. For example, Pound New Zealand, you look at this over here, right? So this won't be a full-fledged candlestick pattern trading course, right? I have videos on YouTube, you can search on that. But you can see that over here we have a bullish engulfing pattern where this candle has engulfed or covered the prior candle. This tells you that the buyers are, momentarily in control. Or this one over here, right, similar to another bullish engulfing pattern slash hammer, right? We have rejection of lower prices over here before the price closes higher for the day. Again, this candle has engulfed the prior day candle. Over here we have what we call the dark cloud cover, where the price has covered the previous day candle by at least 2/3 or more. Okay, then here we have another bullish engulfing pattern. So yeah, basically we are looking for bullish reversal candlestick patterns to help us time our entry to get into a trade, right? So later I'll share with you more examples, but basically these are the things that we're looking for to time our entry. This is another bullish engulfing pattern, another bullish engulfing pattern. Okay, so next one. So once you have your entry trigger, what do you look for? The exit if you're wrong. Because here's the thing, right? You can have all the stars that align together. Everything is beautiful, sweet. Okay, but you could still be wrong on the trade. So this is why we have stop loss to kind of, contain our losses. So where is your stop loss? And a very simple principle I use when setting stop loss is that you want to set it at the level where it invalidates your trading setup. So let me just give you an example. Let's say you are head and shoulders pattern. You want to short the breakdown of this head and shoulders pattern, right? You know what's an head and shoulders pattern. Okay, this is the neckline. So let's say you went short on the breakdown. So where do you set your stop loss, right, for this head and shoulders pattern? So the question you should be asking yourself is, hey Rayner, at which level on this chart, right, will this head and shoulders pattern get destroyed? So that's the question, okay? So if you ask me, right, the head and shoulders pattern will probably get destroyed, right, if it reaches this price point over here, somewhere here, right? Because you can see that if the price breaks down lower and goes back up, clearly this is no longer a head and shoulders pattern. Clearly this pattern is destroyed. This pattern is invalidated. So that's where your stop loss should be. Okay, it doesn't have to be chart patterns. It can be support, resistance, trend line, moving average. The concept works the same. So let me give you an example for, let's say, support and resistance. Okay, so let's have a look at an example for support resistance. So this is Euro Swiss franc. Okay, so at here we can plot our support resistance. Here it says the resistance, and here possibly the area of support. So you can see that right now, price is contained between this area of resistance and support. So let's say you got long at support. Maybe you're bullish on this market, fundamentals looks good, your technicals, everything lines up, you buy at support. But as you know, Rayner says that, in trading, we are dealing with probabilities. All the stars can align. The moon, the star, Satan, Jupiter, whatever, all align. And you can still get a trade wrong. So now the question is, hey Rayner, at which level on the chart will support be invalidated? Will support be destroyed? That's the question you should be asking yourself. So if you ask me, right, you know that support is an area on your chart. It's an area. I mean, although I draw it as a line, right, we both agree that it's an area on a chart. Something like this is an area. The price could break briefly below support and then reverse up higher. So we want to give our stop loss some buffer. Okay, so how do we kind of give it a buffer? So what you can do is pull out the ATR indicator. Search for ATR, stands for average true range. I typically go with the 20 period ATR. SMA, click OK. Beautiful. I can be a poet. Okay, so anyway, we can see that the current ATR value right now is about 40 pips, right? Let's make my life easier. It's 39.1 pip, but let's make it 40 pips. So what you want to do is to find out what is the low of support. Okay, so the low of support, we can either treat it as this level here, all right, or if you want to be more precise, you can even use this level over here. But let's keep things simple. Let's use the low as 10722. Okay, so what you'll take is 10722. This level you minus 40 pip. So I'm going to take 10722 minus 40 pip, and it gives me something like 10682. So my stop loss is going to be at 10682, which is at this level over here. I'm going to change this to ping, and my coordinate will be 10682, okay, which is 40 pips, right? So basically, just to walk you through, this level here at this price point, you minus 40 pips, which is one ATR value, which you got it from here, gives you this red line over here. So this is your stop loss, okay? So at this point, right, you can agree that, hey, if the price touches this red line, let's say the price collapses down to this red line, this support looks broken, right, Rayner? Yep, I agree, right? If the price reaches that pink red line, support clearly looks broken to me. Okay, so you can see that this is what we mean by setting your stop loss at the level, right, which invalidates your trading setup. So at this point, we are almost there, but not quite. So you can see what I mean. This market still could possibly become a false break where it reverse up higher, and you'll be thankful that you didn't set your stop loss just smack below this low. So, right, so this is why we give our stop loss some buffer, and that's how to do it, right? 1 ATR below the price structure. So moving on, number 5, right? How do you exit if you are right? So what if you get the trade correct, right? Where do you exit your winner? So this boils down to really, right, whether you want to be a swing trader or a trend follower. So for this video, we are just going to focus on swing trading, since I believe most of you are into swing trading. So basically for swing trading, you want to have a fixed target profit, possibly exiting your trades before the swing high or swing low, depending on your trade direction. If you want to ride a trend, you can just use a tool like a trailing stop loss. Okay, so with that said, right, let's use the concepts that you've just learned, right? The 5 steps. Number 1, let me just do a quick recap. The trend, the area of value, the entry trigger, the exit if you are wrong, and the exit if you're right. I call this the Tay formula. Let's use this Tay formula and look at some trading examples and see how it works in real life. We'll cover FX and stocks, right? So you can see that the concepts pretty much work the same. So let's get started. So, and by the way, right, the examples that I'm about to share with you, yes, they are cherry picked. Obviously, they are cherry picked because I want to share with you the concepts, right, that work, how it works based on historical chart. Of course, in trading in real life, it's not going to work all the time, right? But of course, to prove my point, I'll pick a chart, right, that are winners, so you can actually visualize, right, how it looks like, right, instead of showing a chart that goes wrong and you kind of, get confused. Okay, so bear in mind, the charts are cherry picked, but in real life trading, you will face losses, series of losses, right? Don't be surprised. So this is just a quick disclaimer, right, to those of you who are, thinking that this is going to work all the time. So let's get started. First one, I'll just get rid of the ATR indicator first. Okay, so let's look at Aussie Canadian. So if you look at this market, again, what is the first thing that we are looking for? Remember, number 1, the trend. So what's the overall trend in this market? So let's call it number 1, the trend. All right, it's towards the upside. Okay, great. Number 2, area of value. Right, this area of value, you can see that I'm looking at this area of value over here, which is an area of support. So let's call it S for support. I'm going to do something like this, right? So you can see, okay. Next one, entry trigger. Do we have an entry trigger? So again, when we talk about entry trigger, it's something as simple as, bullish reversal candlestick pattern. We just simply have a very nice bullish higher close over here. That's a valid entry trigger. So I'll just call it BC, right? Bullish close. Exit if we are wrong. So where do you think we should set our stop loss, right, if the market goes against us? So remember, Rayner said, set your stop loss, right, where it invalidates your trading setup. So your trading setup is simply trading at support, right, in an uptrend. So where might this support area break? Chances are it's probably somewhere about here. I would say your area of support is broken if the price can reach this level. So again, you can use the ATR technique I share with you. 1 ATR below support, right, that would be your stop loss. Okay, so that's your exit, which is your stop loss. And how about exit if you are right? The final E. Let's put it here. The final E. Exit if you are right. So if as a swing trader, you can just look to capture one swing in the market, and the question to ask yourself is, where might potential selling pressure come in? So if you ask me, possible areas is over here and over here. So you can have 2 possible targets, right, to capture a swing for this market. Make sense? Okay, this is the Tay formula, right, here with you step by step. Moving on, let's look at the stock. Netflix, right? I think most of you watch Netflix. So let's have a look at this stock and see how this one works out and plays out. So trend is up. Area of value is at this area of support, which you can see over here. Okay, this area of support. Entry trigger, we have what I call a false break. Let's call it FB. I know what you're thinking, right? Not that FB, right? FB, false break. So you can see that the price trades below this prior low, and then it closed bullishly on the next, on a subsequent candle, right? So basically, it took out the stop loss by traders who set their stop loss below these lows and make a quick reversal towards the upside. So this is what I call a false break, where the price take out the lows of support only to reverse up higher. So you can enter on the next candle open. So we have the false break. Exit if you are wrong. Where is your stop loss? Okay, your stop loss again is at a level where your trading setup is invalidated. You can use your eyeball to see that, oh, okay, if the price hits 440, right, I know this area of support doesn't hold, I should get out of the trade. But if you want something more objective, you can use the ATR technique that I shared with you earlier. And finally, exit if you are right. Right, could be at the swing high. So let's call it SH, right, swing high. Right, possibly around here where you can look to take profits if the market does swing up higher. So again, this is the Tay formula in action. So let's look at a couple of more examples before we sum up today's video. So we get another one over here. So this is just so similar as the Netflix example. The only difference is that the duration, right, that the price takes to form this range over here. Okay, so again, trend, uptrend. Area of value, that is area of support. Entry trigger, we have another FB, false break. Okay, let's call it FB. Exit again, exit if you are wrong. Stop loss can be 1 ATR below this most recent swing low, so be somewhere about here. That's your stop loss. And finally, your exit could be at this recent swing high over here. Okay, so as mentioned earlier, for exit is it's up to you whether you want to capture a swing or trail your stop loss. If you want to ride the trend, then clearly you need to trail your stop loss, and you can trail your stop loss using, you know, price structure. As the market continues to make a series of higher highs, higher lows, you can just trail your stop loss below the recent swing low, or you can use a moving average to trail your stop loss. Okay, so this is pretty much how this one works. And one last example, let's go back to the FX markets. So again, this one 8-hour time frame. Okay, so you can see over here, what is the trend of this market? Overall trend is towards the downside. This market is in the downside. Okay, area of value, I'm seeing over here, right? This one over here, where previous support could become resistance. So I'll call it R, resistance. Entry trigger. Okay, we have a bearish engulfing pattern, as you see over here. Let's call it BE, bearish engulfing pattern. Exit if you are wrong. Again, we set our stop loss, right, where it will invalidate our trading setup. And this is where things get a little bit tricky. So you can see that in the real world of trading, right, things might not be as clear cut. So now you have an option. Hey, Rayner, do I reference my stop loss on this high or this high over here? Because if you set your stop loss 180 or above this high, it might be just smack above this this level here, which is an area of resistance. So this really depends on how conservative you want to be. So if you are really conservative, you want to really protect your stop loss, right, and prevent it from getting stop hunted, you will reference this highs over here, right, and set your stop loss 180 or above this highs. So you'll probably be somewhere about here is your stop loss. Okay, you can see that the stop loss is going to be pretty wide, right, but that's the price you have to pay, right, so that you can avoid, the price spiking up through the highs, spiking up through resistance only to stop you up for a loss. Okay, so that's the price you have to pay. And finally, right, exit if you are correct, right? So that's your stop loss. Exit if you're wrong. Now exit if you are right. So over here, exit if you're right. This one is a stop loss. Okay. And I would say possibly at this swing low could be your exit if you are right. So let's call it SL, swing low. Okay, so again, this is how the Tay formula works. Hopefully this example gives you, right, a good idea to how you can trade pullback. And of course, this isn't the examples I've picked, right, are mainly support resistance, because these are my favorite type of area of value to trade off. But again, it's not the only one. You can use trend line, you can use moving average. You have to go and validate the concepts that I've shared with you, right, and see what works best for you. So this is where your forward testing, your back testing comes into play. Don't take what Rayner says at face value. I may not be right, gotta do the work. Fair enough? Okay, so with that said, let me share with you a bonus tip, right, for those of you who trade stocks. I know a number of you who trade stocks, right, whether you're trading the US stock markets or the Indian stock markets. What you want to do is to focus on buying the strongest stocks. So for example, let's say you are looking at two possible stocks, stock A and stock B, and they have very similar trading setup. So for example, earlier I shared with you the setup on Netflix and SUMR. Their setup is pretty similar. And you're undecided, man. Man, Rayner, which one should I choose, man? Should I go with stock A or stock B? So one tip that I have for you is to focus, right, on buying the strongest stock out there. So what you can do is simply go with the stock, right, that has increased the most in price over the last 6 to 12 months. Why is that, right? Because academic research have proven, and my own backtesting has proven, right, that stocks, right, that has increased the most, right, over the last 6 to 12 months are the ones that are likely to outperform the market. So one thing you can do is, let's say, let me just go back to the charts. Let's say you're looking at SUMR. Okay, on the daily time frame, at this point, right, you're thinking, should I buy this stock? You compare it with Netflix. So what you can do is pull out a tool called the rate of change. It measures the percentage change in price over a given period. Right, go to the weekly time frame. Okay, so at this point, the weekly is about here, and find out, right, how much the price has increased, right, over the last 50 weeks. So over here, I'll change to 50. Okay, so at this point, you can see that. Okay, let's go at it most extreme right. So at this point, let's assume, right, for example, there's a valid setup on SUMR you're looking to buy. And you can see that over the last 50 weeks, this stock price has increased 663%. How do you know that, Rayner? Well, because it's shown over here, 663. So it's pretty strong stock. And if you compare that to Netflix, let's say Netflix, you have another valid trading setup, and you realize, oh, this stock has increased only 85%. So what you want to do is go with the stock, right, that has the highest ROC value over the last 50 weeks. So if you think about it, 50 weeks is about over the last 12 months, right, the increase in price over the last 12 months. So that is the stock that you want to go. So if you trade stock, right, this is a very useful filter, right, for you to identify a high probability trading setup. And of course, avoid those stock, right, which are very weak, or those stocks the ROC value is even lower than the index itself, like S&P 500. If let's say S&P 500, the ROC value is let's say 20%, and the stock that you're looking to buy is let's say 15, then I would say, you might want to avoid buying that stock, right? Focus on stocks, right, which are strong, right? These are the ones that are likely to outperform the market. So quick recap to what we have learned today. Number one, right, when you trade pullback, first and foremost, the trend. Next one is the area of value. Could be support, resistance, trend line, etc. Then an entry trigger. Could be a false break, FB. I know what you're thinking. Hammer, shooting star, etc. Next one is your exit if you're wrong, which simply means it's our stop loss. Where on the chart, right, will your trading setup be invalidated? And finally, right, exit if you're right. And in total, I call this the TAE formula. T-A-E-E, TAE formula. Okay. So anyway, if you want to learn more about, price action trading, you really enjoyed today's training, then what you can do is go down to this site over here called Price Action Trading Secrets. This is a 140-page color trading book, physical trading book, right, that I will ship out to you, okay, where you'll discover, right, professional price action trading strategies that you can use to trade the FX market, stock markets. We talk about reversal trading, breakout trading, risk management so you never blow up another trading account, trade management, position sizing, and all the fun stuff like this, right? So if you are really interested in price action trading, just go down to the link, I'll put it below this video, and grab a copy of Price Action Trading Secrets. So with that said, I wish you good luck and good trading. I will talk to you soon.